All right, everyone, so we are going to go ahead and get started with the second half of Chapter 5. So like I said before in the first part, split this into two separate parts simply because it was really, really long. So here is the second half of Chapter 5. So the first learning objective that we're going to cover with this second part of Chapter 5 is that we are going to adjust and close the accounts of a merchandising business. You will notice that this will be very, very similar to that of a service business, but there will be some differences that we will make note of. What are the adjusting and closing entries that we have to make for a merchandiser that we don't necessarily have to do for a service business? So for the first one we have to look at what the actual inventory is that we have on hand. So we have to go through and do that physical count, and then we compare that to what our books say that we should have. If those two numbers are off, especially if we are missing products, that is what we refer to as inventory shrinkage, and that is the loss or theft or damage of inventory that takes place. The greatest place for inventory shrinkage to take place is actually for employees of the business to actually steal that inventory. So fun little side fact there for you. It is a requirement that businesses take a physical count of their inventory at least once a year. Most businesses will do it more often than that. And that also just kind of depends on the size of the business and how often they decide to do that. And we are, once again, assuming that we are using the perpetual inventory management system in this case. Even with the perpetual system, we still have to do physical counts at least once a year. And then we have to adjust that inventory based on that physical count. So that adjustment that we see here takes place. So Smart Touch Learning's merchandise inventory account shows an unadjusted balance of $31,530, but a physical count comes to only $30,000. So we see here that there is a loss of $1,530 of merchandise inventory, and we see that the journal entry for that looks like this. We have a debit to cost of goods sold for $1,530 and a credit to merchandise inventory to reduce that inventory count, to reduce that inventory amount by what we noticed the difference was. And take note that we put that shrinkage into cost of goods sold, because whether, we actually have that inventory or not, we still have to pay for it. We still have paid for it. So those who stole it from us, it sucks. We still have to pay for that inventory though. And that's where we're at. If we can find the person who did it, great, maybe we can recover, but most of the time you're not able to. So when we go to close the accounts of a merchandiser, again, this looks very, very similar to that of a service industry business. So the first step is to close all of the revenue accounts to income summary, and then we close all of the expense accounts to income summary, and then we close income summary to the capital account. Again, this is the same thing that we do in a service business, and then we also close the owner withdrawals accounts to the capital account as well. So we can see here, Exhibit 5-6 here shows their adjusted trial balance and closing entries for the year. So the new accounts that we have are highlighted in blue, and these are also ones that we will end up closing. So we see here we've got some new accounts here: the refunds payable, the sales discounts forfeited, the cost of goods sold. It's important to note that sales discounts forfeited is actually a revenue account, so that's an important one to take note of. So here are our closing entries, and again, they highlighted those new accounts in blue. So we noticed the first one, to close the revenue accounts, we see sales revenue and sales discounts forfeited, and we close those to income summary. Then we need to close all of our expense accounts to income summary. Cost of goods sold in this case is considered an expense account, so we close that to income summary as well at this point. And then we close income summary to the capital account, and then we close the withdrawals to the capital account as well. So again, this should look very, very similar to what we saw back in Chapter 4 for closing entries. We just have a few new accounts in there as well. Our next learning objective is we are going to prepare the merchandiser's financial statements. Once again, these financial statements are going to look very, very similar to what we've done in the past, but there will be a couple of differences, and most of those differences will take place on the income statement in this case. So we are going to be moving from a single-step income statement to a multi-step income statement, and this, just like that classified balance sheet, this just gives us a little bit more of an in-depth look and categorizes some of those different categories that we'll have within our income statement. Just as a refresher, here is the single step income statement. So we see here the revenues are at the top, followed by the expenses. Take the expenses from the revenues, and we get our net income. Notice that there's really no categories happening here. We've got revenues and expenses, but that's about it. We see our net sales revenue and our sales discounts forfeited, because those are both revenue accounts, and then we see all of our expenses, and in this case cost of goods sold is kind of bunched in with those expenses. So we're going to start talking about the multi-step now, which will be the income statement we'll kind of be using moving forward. So the multi-step income statement, we separate our expenses into two different categories. We have selling expenses and administrative expenses. The selling expenses are going to be related to the marketing and the selling of the company's goods and services, and then the administrative expenses are the things that are not necessarily related directly to those goods. So it could be things like rent, it could be things like the CEO's salary, general upkeep of the business, lights, having the lights on so that we can work, those types of things. And then the next thing that we'll do is we will have the gross profit minus the operating expenses will equal our operating income. We also have the other income and expenses section of this income statement, and this will show any revenues or expenses that are outside of the normal day-to-day operations of the business. So this will show, like, if we sell like a piece of equipment or if we sell a piece of land, this would be reported in the other income and expenses area. So here is our multi-step income statement. So it's still got the same exact accounts as that single step. We've just broken this down and we've put it into some different categories here. So we see up at the top, we see our net sales revenue, and then we have our cost of goods sold, and it's less that cost of goods sold gives us our gross profit. So they take the revenues, the net sales revenues, and they subtract out the cost of goods sold to give us our gross profit. And then from there we separate in, we have our expenses, and we have our selling expenses and our administrative expenses. Breaks those down into two categories, gives subtotals in between, and then we have our total operating expenses. And we take that from our operating income, or we take our total operating expenses from our gross profit, and that gives us our operating income. Then we go into our other category. So this is other income and expenses. This is where the sales discounts forfeited comes into play. Interest expense goes in here as well. And still, all the way at the very bottom, we still get our net income or our net loss number. In this case, there is a net income. The statement of owner's equity and the balance sheet. The statement of owner's equity is going to look just the same as it did for a service business, and the balance sheet will still be utilizing that classified balance sheet just like we did for the service business. The biggest difference here is that we're going to have a couple of new asset accounts. Not really a huge deal: merchandise inventory and estimated returns and inventory. Learning objective 6, we are going to use the gross profit percentage to evaluate the business performance. The gross profit percentage measures the profitability of each sales dollar above the cost of goods sold. So we look and we see, okay, how profitable is this business actually going to be? For each dollar that we sell, how much money are we actually making? So in order to calculate that, we need a couple of key pieces of information. And we do this per year, essentially. So we need to know what the net sales were and the cost of merchandise sold, and this, we can use those two numbers then to calculate our gross profit percentage. So for Kohl's, we do this for 2 years, and we want to compare those 2 years then. So for 2015, we take our net sales less our cost of merchandise sold or cost of goods sold, and then we divide that again by our net sales, and that gives us 36.4%. For 2016, we're at 36.1%, so those numbers are super close to each other. And for a year-to-year thing, we would want those to be relatively similar. This again, so we are getting into the appendix now for this chapter. There's several different slides here for the appendix. These things are not things that you will be tested on. These are just for kind of your information at this point. So account for multiple obligations using a perpetual inventory system. So how do we do this? So companies are required to identify performance obligations associated with each contract, and then that performance obligation is a promise. We have made a promise to the customer, and we have to deliver upon that. And when they involve multiple obligations, then we have to allocate the transaction price per obligation. So in order to do that, this is kind of what that looks like. So on November 1st, Smart Touch Learning sells one tablet, cost of $350, along with a 2-year service contract to a customer for $620 cash. It's not uncommon for businesses to do things like that. So we need to allocate the sales price of the $620 as follows: $500 for the tablet and $120 for the 2-year service contract. And we'll break that down because that service contract has not been executed yet, so we haven't provided that service yet. That's going to go into unearned revenue. So this is how these transactions would look, and we're assuming that cash was paid for this transaction. So we see an increase to cash of $620 for a tablet and the service contract. Sales revenue increases by $500 right away for that tablet because that tablet has been bought and paid for, and then unearned revenue increases by $120 for that service contract. We then have to take the $350 and add it to cost of goods sold and remove it from our merchandise inventory, and now we have the service contract that's hanging out in unearned revenue. And we can take that, as a monthly or a yearly basis. Just depends on how we decide to execute that contract. So in this case, they are deciding that they're going to do it monthly, and so it's $10 per month for that service. So we see that each month then we'll have a journal entry that looks like this. So unearned revenue will be debited for $10 and service revenue will be credited for $10. And we would do that for the next 24 months. Learning objective 8, we're going to account for the purchase and sale of merchandise inventory using a periodic system. So everything we've done up to this point has been for the perpetual, and that's because it's the most commonly used inventory system. So now we're going to take a quick look at the periodic inventory system just so you have that general knowledge. Perpetual inventory systems are too expensive for some of the smaller businesses, and that's why they may elect to use the periodic inventory system. In today's day and age, with all of the technology that's out there for small businesses, we still see a number of small businesses using the perpetual system, but there are still some that opt to use the periodic system, and typically those are the businesses that do not have any type of accounting systems really in place. So they have to count their inventory on a regular basis to determine what they have on hand. So when we see that, this is how the journal entries look. You'll notice that it's really pretty much the exact same as it was for the perpetual system. We'll see those differences come into play here in just a second. So when we look at this on June 3rd, there was a purchase of inventory and then a payment for that inventory as well. So we had a purchase of $35,000. And so that went into purchases instead of inventory, merchandise inventory, and then accounts payable because we haven't paid for it yet. So then we pay for that invoice, so we pay it the $35,000, but we take advantage of that 3% discount. And again, same basic thing that we had earlier in the chapter. We still return $7,000 worth of that inventory to the vendor, okay, prior to that payment. So accounts payable is reduced by $7,000. Purchase returns and allowances is credited for $7,000. When we are reporting the purchase returns and allowances, we have to make sure that we're getting to a net purchases amount at the end of the day. So this is the remainder after subtracting all of the contra accounts for the purchases. So we have the initial purchase, right? And then we have the return, and then we have the discounts as well. And so we end up with this net purchases amount. And this is really the amount that we should have on hand. So regarding the transportation costs here, they still have to pay the freight charge, so it's freight in $60 cash, paid cash, no big deal there. Then when we sell the merchandise inventory, because there's no running record of this, okay, there is no need to record the entry for merchandise inventory and cost of goods sold. We'll take care of the cost of goods sold eventually down the line when we do our hand count, our physical count. So we do need to still though account for any sales discounts or returns, and this is the exact same as it would be under the perpetual system. So we have the record of the sale here. So accounts receivable 4,900, sales revenue 4,900 as well. This was under terms of 210 net 30. And remember, we always record a sale utilizing the discount, assuming that the customer is going to take advantage of the discount, because we never want to overstate our revenue. We would rather understate it and just account for that difference later on. When we go to prepare the financial statements, so we do have to calculate the cost of goods sold, in this case based off of our hand count of the merchandise inventory that we have on hand, because we are using that periodic inventory system. So we'll have to go through and we'll have to do the physical count, and then we'll have to do those calculations for the income statement. So here we can see the calculation taking place to determine the cost of goods sold. So we have the initial purchases less the purchase returns and allowances less the purchase discounts gives us the net purchases plus our freight in, because remember that freight cost does have to translate to our inventory as well. So plus the freight in, and then we have our net cost of the purchases. So then we have to determine our cost of goods sold. So we look at it this way and we see, okay, our cost of goods sold, our cost of goods available for sale should be this number, and then we subtract our ending inventory from that. So what do we still have left on hand? And then that gives us our actual cost of goods sold, which is $540,000. Adjusting and closing entries. So there's no adjustment required for inventory shrinkage, because there's not a perpetual system running, and because we're already doing those physical counts, we don't have to record for that. But we would still be able to determine how much we had lost based on shrinkage, just by knowing kind of what we should have on hand. Instead, we will just determine the merchandise inventory by taking a physical count, and then we will record that through the closing entry process. So again, we still see our new accounts here, and we have our temporary accounts that we're going to be closing out in this process, which is still our withdrawals, our revenues, and our expenses. So we see here our closing entries. They're a bit more complicated under the periodic system. We just have a whole lot more revenue accounts that we have to take into consideration. So we close all of our revenue accounts, so sales revenue, sales discounts forfeited, purchase returns and allowances, purchase discounts, merchandise inventory ending, and then the estimated returns inventory. We close all of that to income summary. Then we close our expenses. Our expenses now include purchases, freight in, and merchandise inventory at the beginning, because it is plausible that you would start a period with merchandise inventory, especially if your business has been around for a while. And then all of our normal expenses, and then the last two entries are the same. We still close income summary to capital, and then withdrawals to capital as well. So just a little bit more on those adjusting and closing entries. It's still a 4-step process under the periodic system. Step 1, though, is, like I said, it's a little bit more complicated because we've got more accounts that we have to close down. So we close our sales revenue, our sales discounts forfeited, and then we close all the other temporary accounts with credit balances in that instance. And then we have to close, the merchandise inventory, and the estimated returns inventory are recorded as debit. In step 2, we close all of the expense accounts. We also close the beginning inventory purchases and freight in. Steps 3 and 4, again, these look just the same as they would under the perpetual system. So we still close income summary to capital, and then withdrawals to capital as well. Learning objective 9, we're going to account for the sale of merchandise inventory using the perpetual inventory system and gross method. So essentially, what is this? So the amount a business earns from selling merchandise inventory is called sales revenue, which we already know this, right? So there are 2 entries that are required to record these transactions. The first one is the sales revenue, and then cash or accounts receivable. And the second entry is for the cost of goods sold and the merchandise inventory. When we have a sale with cash and credits, this is when this really comes into play. So we're going to start looking at this. So we sent out the sales invoice for 2 touchscreen tablet computers, $500 each, total of $1,000. And this was on June 19th. If they pay cash for this, this is what those journal entries would look like. So cash obviously goes up $1,000, sales revenue goes up $1,000, cost of goods sold increases by $700, and merchandise inventory decreases by $700. Because remember, while we charge the customer up $500 per tablet, our cost is $350 per tablet. If we're doing it on account, it looks like this. So they bought 5 tablets in this case, so accounts receivable increases by $2,500, sales revenue increases by $2,500, cost of goods sold increases by $1,750, merchandise inventory reduces by $1,750. If we have a sales discount that's happening, again, we're going to take that right away. We're going to assume that they're going to utilize that sales discount. So when we determine sales discounts, there's a couple of different ways we can do it. We have the gross method and the net method. The gross method, we record all sales at the full amount gross and record any discounts taken at the time of payment. So there's that. And then we have the net method, where we record all sales at net amounts at the time of the sale and record the adjustment at the time of payment for the discounts not taken. Typically we utilize the net method, but the gross method can also be utilized. I highly recommend that you utilize the net method whenever possible. Just again, because we really don't want to overstate that revenue. That can get us into trouble in the long run. So utilizing the gross method, this is how it would look. So everything we've done up to this point has been the net method. This is the gross method. So we send out this invoice for our 10 tablets at $500 each with the payment terms of $210 net $30. In this case, we're assuming that they're not going to take that discount right away. So we record it as accounts receivable is increased by $5,000, sales revenue is increased by $5,000, cost of goods sold is increased by $3,500, and merchandise inventory is reduced by $3,500. Then when they go to pay it, if we say, if they did not pay within the correct time, record it just like this. Cash increases by $500, accounts receivable reduces by $5,000. And we don't have to mess with, sales discounts forfeited or anything like that. So in that regard, the gross method is easier. However, it can lead to the overstatement of revenue, especially if we have a period end before an invoice is due. So now, if they were to take that discount, so they pay within those payment terms, and they take that 2% discount. Now we have to do this. We have to do more of the math on the back end. So our cash still increases by $4,900 because they took out off the 2% for their discount, and then we have a new account that's called sales discounts, which is just for that 2%, which is $100, and then accounts receivable is reduced by $5,000. So this is just what that journal entry looks like in a very cleaned up way. So we have sales discounts, and that is also an equity account, so essentially a revenue account in this case, but it reduces revenue because it's a discount. So this is the side-by-side of the gross versus the net. We will typically just utilize the net method. The gross method is just there for your information purposes, but we typically utilize the net method. All right, and that is it for Chapter 5. Awesome.